Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of today's video is to discuss a $1 million retirement plan with 401k, solo 401k for 2025. So a one participant 401k plan is sometimes called a solo 401k, solo k, unique one participant k. The one participant 401k plan isn't a new type of 401k plan. It's a traditional 401k plan covering a business owner with no employees, or that person or and his or her spouse. These plans have the same rules and the requirements as the any other 401k plan. What are the contribution limits in a one participant 401k plan? The business owner wears two hats in a 401k plan, employee and the employer. Contributions can be made to the plan in both capacities. The owner can contribute both elective deferral up to 100% compensations, earned income in case of self-employed individual up to the annual contribution limit, which is $23,000 in 2024, $22,500 in 2023, $20,500 in 2022, $19,500 in 2020 and 2021, or $30,000 in 2023 if age is 50 or above. Then employ non-elective contributions up to 25% of compensation as defined by plan or for the self-employed individuals. If you've exceeded the limit for the elective deferral in your 401k plan, find out how to correct this mistake. What are the total contributions? The total contributions to a participant's account, not counting catch-up contributions for those age 50 and over, cannot exceed $69,000 for 2024. For example, Ben, age 51, earned about $50,000 in W2 wages from his S corporation in 2020. He deferred $19,500 in regular elective deferrals plus $6,500 in catch-up contributions to 401k plan. His business contributed 25% of his compensation to the plan, $12,500. Total contribution to the plan for 2020 were $38,500. This is the maximum that can be contributed to the plan for the 2019. A business owner who is also employed by a second company and participating in its 401k plan should bear in mind that his limits only elective deferrals are by one person, not by plan. He must consider the limits for all elective deferrals he makes during the year. What are the contribution limits for self-employed individuals? You must make a special computation to figure the maximum amount of elective deferrals and non-elective contributions you can make for yourself. When figuring the contribution, compensation is your earned income, which is defined as net earnings from self-employment after deducting both one half of your self-employment tax and contributions for yourself. Use the rate table or worksheets in chapter 5 IRS. How you can test one participant 401k plan. A business owner with no common law employees doesn't need to perform non-discrimination test for the plan, since there are no employees who could have received desperate benefits. There is no testing advantage vanishes if the employer hires employees. No matter what the 401k plan is called by a plan provider, it must meet the rules of the Internal Revenue Code. If you hire employees and they meet the plan eligibility requirements, you must include them in the plan and their elective deferrals will be subject to the non-discrimination testing, a safe harbor plan, or other plan exempt from the testing. If you excluded eligible employees from your 401k plan, find out how to correct this mistake. One participant 401k plan is generally required to file an annual report to form 5500 easy, if it has $250,000 and more in the assets at the one end of the year. One participant plan with fewer assets may be exempt from the annual filing requirements. What are the alternative to one participant 401k plans? Possible plans for 401k is SEP IRA, Roth IRA, and the other types of the plans are also used. So here we will discuss the type of the retirement plans. We will discuss about details of the 401k plans. So a 401k plan is featured of a qualified profit sharing plan that allows employees to contribute a portion of their wages to individual accounts. So elective salary deferrals are excluded from the employee's taxable income except for the designated Roth deferrals. So employers can contribute to the employees' accounts. Distribution, including earnings, are includable in the taxable income at retirement except for the qualified distributions of the designated Roth. So we will now discuss what is the steps to establish a 401k plan. So here are the steps for establishing a 401k plan. When you establish a 401k plan, you must take certain basic actions. First of all, for instance, one of your decisions will be whether to set up your plan yourself. Consult a professional or financial institution such as bank, mutual fund provider, or the insurance company to help you establish and maintain the plan. So what are the initial actions? Here are four basic actions necessary to have a tax advantage 401k plan. First is to adopt a written plan, then arrange a trust fund for the plan's assets, then develop a record keeping system and provide plan information to the participants. Then we will discuss the details of adopting a written plan. Plan begins with a written document that serves as the foundation for the day-to-day plan operations. If you have hired someone to help with your plan, that person likely will provide it. If not, consider obtaining assistance from the financial institution or the retirement plan professional. In either case, you are bound by the terms of the plan document. Before beginning a plan document, however, you will need to decide on the type of the 401k plan that is best for you: a traditional 401k, a safe harbor 401k, or a simple 401k plan. So our traditional 401k plan offers maximum flexibility of the three types of the plans. Employees can choose to make contributions on behalf of all the participants, match employees' deferrals, or do both. So these contributions can be subject to a vesting schedule, which provides that an employee's right to the employer contributions become non forfeitable and only after a period of time. So in addition, our traditional 401k allows the participants to make pre-tax contributions through payroll deductions. Annual testing ensures that benefits of for the rank and file employees are proportional to the benefits for the owners and managers. A safe harbor 401k plan is similar to the traditional 401k plan, but among other things must provide for the employer contributions that are fully vested when made. However, a safe harbor 401k is not subject to many of the complex tax rules there are that are associated with the traditional 401k plan, including annual non-discrimination testing. An automatic enrollment 401k plan allows an employer to automatically deduct fixed percentage or amount for an employee's wages and contribute that the amount to the retirement plan unless the employee has affirmatively chosen to contributing nothing or a different amount. These automatic enrollment contributions qualify as elective deferrals. So, revenue ruling 2009 to 2030 demonstrate ways a 401k plan sponsor can include automatic contribution increase in its plan. Notice for 2009 to 65 provides sample automatic enrollment plan language that 401k plan sponsor can adopt with automatic IRS approval. The traditional safe harbor and automatic enrollment 401k plans are for the employees of any size and can be combined with the other retirement plans. A simple 401k plan was created so that small businesses could have an efficient, cost-effective way to offer retirement benefits to their employees. A simple 401k plan is not subject to the annual non-discrimination test that apply to the traditional plan. Similar as to a safe harbor 401k plan, however, the employer is required to make the employer contributions that are fully vested. This type of 401k plan is available to employers with 100 or fewer employees who received at least $5,000 in compensation from the employer for the preceding calendar year. In addition, the employer can't maintain any other retirement plan. Once you have decided on the type of plan of your company, you will have flexibility in choosing some of the plan's features, such as which employees can contribute to the plan and how much. Other features written into the plan are required by law. For instance, the plan document must describe how certain key functions are carried out, such as how contributions are deposited in the plan. So, the second point is to arrange a trust fund for the plan's assets. A plan's asset must be held in trust to assure that assets are used solely to benefit the participant and their beneficiaries. The trust must have at least one trustee to handle contributions, plan investments, and distributions to and from the 401k plan. Since the financial integrity of the plan depends on the trustee, this is one of the most important decisions you will make in establishing a 401k plan. If you set up your plan through the insurance contracts, the contracts do not need to be held in the trust. So, how to develop a record keeping system? An accurate record keeping system. Record keeping system helps track and properly attribute contributions, earnings, and losses. So, plan investments and expenses and benefit distributions in participants' accounts. If you have contract administrator or the financial institution assist in managing the plan, that entity typically will help in keeping the required records. In addition, record keeping system will help your plan administrator or the financial provider prepare the plan's annual return report that must be filed with the federal government. And then number fourth is provide plan information to the employees. As you put your 401k plan in the place, you must notify employees who are eligible to the participants in the plan about your plan's benefits and requirements. A summary plan description or SPD is the primary vehicle to inform participants and the beneficiaries about the plan and how it operates. The SPD typically is created with the plan document. You will need to send it to all plan participants. In addition, you may want to provide your employees with information that emphasizes the advantages of joining your 401k plan. Employees perks such as pre-tax contribution to a 401k plan or tax-free distribution in case of Roth 401k, employer contributions if you chosen to make them, and compounded tax deferred earnings helps the highlighting advantages of the participating. Now this was all about to establishing a 401k plan, and then we will discuss about the required minimum distribution. So retirement topic, required minimum distribution. You cannot keep the requirement funds in your account indefinitely. You generally have to start taking withdrawals from your IRA, simple IRA or SEP IRA or the retirement plan accounts when you reach the age 73. You are not required to take withdrawals from the Roth IRA or from the designated Roth accounts in a 401k or a 403b plan while the account owner is alive. However, beneficiaries of the Roth IRAs or the designated Roth accounts are subjected to the required minimum distribution rules. Your RMD is required minimum distribution amount, the minimum amount you must withdraw from your account each year. You can withdraw one or more minimum amount, required minimum amounts. Your withdrawals will be included in your taxable income except for any part that was taxed before your basis or that can be received tax free, such as qualified distributions from designated Roth accounts. So do these plan apply to my retirement plan? The minimum distribution rules discussed below apply to the original account holders and their beneficiaries of these plans. And the plans are traditional IRAs, SEP IRAs, simple IRA, 401k plan, 403b plan, 457b plans, profit sharing plans, other defined contribution plans, and the Roth IRA beneficiaries. Calculating the required minimum distributions. The required minimum distribution for any year is the account balance as the end of the immediately preceding calendar year divided by a distribution period from the IRS Uniform Lifetime Table. Use a different table if the sole beneficiary is the owner's spouse who is 10 or more years younger than the owner. The following can help determine the payout period and the amount of your required distribution. Worksheet to calculate the required amount, tables to calculate the RMD during the participant IRA's owner life, uniform lifetime table for all unmarried IRA owners calculating their own withdrawals, married owners whose spouse are not more than 10 years younger, and married owners whose spouse are not sole beneficiaries of their IRAs. So now we will discuss how to operate a retirement plan. So find what you need to operate retirement plan and keep it compliance with the law. Recent developments changes the guidance and the law and the procedures that affect the employee plans. So digital form 15315 annual certification for the multi-employer defined benefit plans. The IRS the IRS employee plan recently digitalized the form 15315 to allow you electronically report the actuarial certification of a multi-employer defined benefit plans funding status. The mobile friendly forms web page has a glitch that wouldn't allow you to enter a date beyond 31 December 2025 or a plan number beginning with 0, for example 002. So note that the IRS is now accepting form 15315 certification by mail, fax or email. So the 401k limit increases to the 20,000 $20,500 for 2025. IRA limits remains $7,000. The IRS announced that the amount individuals can contribute to their 401k plans in 2025 has increased. So that was all about today's topic. Hope this video will be very beneficial for you. So do subscribe my channel for more helpful stuff. Thank you.